Hello, everyone. Thanks for tuning in. I'm your host, Michael Zagorski. The energy sector has piqued the curiosity of many investors after its blistering performance since the start of the pandemic, specifically the oil and gas industry. So, for years, its performance languished while the broader market boomed. Case in point was crude oil. It saw its price tumble to multi decade lows in 2020. The onset of the pandemic saw demand for oil plunge, which further depressed prices. At one point, futures contracts were actually trading for negative value, meaning producers were paying traders to take oil off their hands. But then, suddenly, a reversal. Demand for oil returned as pandemic restrictions started to lift, and at that point, there wasn't enough supply to keep up. So prices roared back and then hit some multi year highs, all within the span of a year. So as a result, the energy sector has been on a tear in the first half of 2022. So for instance, the Morningstar US Energy Index, here in yellow, it gained 30% as of June 30th. Meanwhile, the Morningstar US Large Cap Equity Index, here in red, it sank about 20% during that same time. So it has some investors reconsidering the energy sector, and oil and gas companies particularly. With that said, oil and gas industry may not be quite as straightforward to understand as others. Some common fundamental metrics that investors might use when researching stocks may not neatly apply. So we're going to take a closer look at some of the key factors that Morningstar analysts use to research oil and gas companies and estimate their fair value. Joining us is David Sequeira, Chief U.S. Market Strategist at Morningstar. He's going to walk us through the process and clear up some misconceptions about the oil and gas industry. So thank you for joining us, David. So it's been a bit of a wild ride with even some negative prices, David. So what did you guys think of that at the Morningstar team, and how surprising was some of those wild swings?
The volatility back in the early days of the pandemic are certainly some of the greatest, volatility and swings I've ever seen in the course of my career. I started off in the business in 1991, and I've had, a couple of different positions with like some hedge funds and other alternative asset managers before coming to Morningstar. And back during like the global financial crisis in 2008 and 2009, I thought I'd seen it all, at that point in time. But again, one thing I had never seen was commodity prices actually go negative to the point that those producers actually had to pay the buyers, to take commodities off their hands.
Yeah, it's pretty rare. I've been following the markets for a long time. Never quite saw something like that either myself. We do have a lot to cover, so let's get into it. First off, can you describe some of the different types of businesses that fall under the oil and gas sector?
Now, the oil and gas industry, is broadly divided into three, key areas. So the first is the upstream businesses, and that refers to anything having to do with the exploration and the production of oil and natural gas. So that includes activities such as the geologic surveys, to actually drilling the oil wells, and then pumping that oil, out of the ground. The midstream business, that refers to anything that's required to transport and store crude oil and the natural gas before it's refined and processed into fuels and other elements. So for example, that includes the oil pipelines, pumping stations, tankers, and so forth. And then lastly, there's the downstream business. And that refers to anything that's involved in turning that crude oil and natural gas into those finished products. So that includes refining the crude oil into usable products such as gasoline, diesel, kerosene, jet fuel, heating oil, and so forth. And then lastly, there are the services businesses. And those consist of those companies that assist energy companies with each of these different tasks.
Thank you. So, a second question further to that. So, the oil and gas industry is cyclical in nature. So, what does that mean, and what might investors want to keep in mind when they are researching these companies?
Well, I consider a business really to be cyclical when it has, peaks and valleys that are in conjunction with the expansion and the contraction of the economy. Now, the time between those peaks and valleys, certainly can vary, but we do see a correlation with the economic cycle over time, and generally those will follow one another. Now, in the oil and gas sector, like the energy sector in general, is cyclical because it is very highly correlated with the economy. So when economic growth is robust and expanding, there's an increase in business activity generally, and so therefore there's going to be more demand for energy. And as that occurs, energy prices are going to tend to rise because there's more competition for what's essentially a limited supply of energy sources. So that then leads energy producers to investing more in production capacity so that they can then meet that demand. Now on the other side, when economic growth starts to slow and there's less business taking place, there's less demand for energy and the prices of oil and gas prices will fall as there's excess supply compared to the amount that's needed. So then that then leads those energy producers to reduce supply until that demand returns. Now it's difficult to predict exactly how long any economic cycle will last because it is really so dependent on various economic and global factors, which can be very difficult to predict.
Oh, thank you. Good, valuable information for our clients. And you do say oil and gas sector is one of the simplest, but also in some ways one of the hardest sectors to forecast. So can you tell why that is and how you sort of go through that approach?
Sure. So putting on my economist hat here, on the one hand, we see the business model for oil and gas to be essentially simple because it's just the price that you get for the product times the amount of production, less your costs, is going to be equal then to your earnings. Now, companies then have a decision how they want to use those earnings. So they'll decide how much do they want to reinvest in growing those production assets over time. So essentially, how much do they want to spend on drilling new oil deposits or looking for new wells, versus how much do they want to pay out to the shareholders in the form of dividends, distributions, or share buybacks. So on the other hand, of course, there are just a lot of complicating factors in being able to forecast prices in production on a global basis. Also, we think it may be difficult to gauge, individually on specific companies, how that company might be able to do for its particular producing assets, based on geological information, which in some cases may not be very readily available. Now, in terms of valuation, we rely primarily on a discounted cash flow model. And so what that discounted cash flow model does is it estimates the present value of an investment today based on its expected cash flows. So that present value of those expected future cash flows is determined by discounting them based on the company's weighted average cost of capital. So if the present value of those discounted cash flows is above the current cost of the investment, there certainly may be opportunities for investors to generate positive returns. However, a discounted cash flow model certainly does also have its limitations, primarily that it relies on those estimates of future cash flows, which of course could be inaccurate.
Okay, well, thank you. So yeah, let's explore those five, the major sort of factors that you look at the Morningstar team when you when you look at the valuation process. So that first factor is the assumption for oil and gas prices. So what would be your approach to developing those price assumptions?
We actually use the 2-year forward strip price for crude oil and for our near-term outlook. So we actually don't even try to predict on our own those near-term oil prices, as there's going to be a lot of fluctuation in those, day to day, month to month, and it's very difficult to predict that because there are a lot of factors at play, such as geopolitical developments. However, we do end up going over and looking at the supply demand over the long term for the entire industry in order to be able to develop our long-term average price. So right now, our forecast over an entire business cycle, including inflation, is $55 a barrel for West Texas Intermediate, $60 a barrel for Brent. So what our analytical team has done is they've determined that that ends up being the marginal price to produce new oil production. So essentially, below those prices, we don't think it's profitable enough to be able to drill new wells given all the costs involved, the infrastructure, and the distribution. So the cost of marginal oil production, that's our estimate that keeps forecasted supply and demand in sync on average over that long-term view.
Okay, that makes sense. So what are the key trends in crude oil demand that the team considers when building out that long-term price assumption?
Well, we start off with looking at, what are the largest or the greatest uses of crude oil and natural gas. So for example, oil, the largest uses are gasoline, diesel, jet fuel, ship fuel, plastics, and so forth. In natural gas, the uses are electric power, residential and commercial heating, and fertilizer. So we'll look at the key demand trends for each one of those products. Now, for example, with gasoline, because that's the largest use for oil, we've looked at the impact to the transition and the growth in electric vehicles. And in the natural gas market, we look towards, the amount of increase in renewables taking over, the amount of electricity used. So, for example, in looking at the electric vehicle space, we expect that 2/3 of new auto production will be electrified by 2030. Now, thinking about what that does for the demand for oil, over the next, 10, 15, 20 years or more, I would just note that the average life of internal combustion engines is about 15 years. So even though we expect 2/3 of new auto production in 2030 to be electrified, all those vehicles that are being produced today with internal combustion engines will still be on the road for a long time period. So as a result, crude oil demand won't fall precipitously, in our view, but it certainly will gradually decline over time. Among some of the other demand trends, that we'll watch, we do see rising demand for crude oil and petrochemicals and air transportation. But conversely, we do see falling demand for crude oil in automobiles and commercial vehicles over the long term.
The second key factor you consider in your valuation is your forecast for an oil and gas company's energy production. It can get complex, but can you just describe briefly how you go about putting that forecast together?
So the approach that we take to forecasting a specific oil and gas company's production is going to depend on the type of producer that they are. So for example, the independent E&P or exploration and production companies, we look to actually determine the consolidated net asset value of each of the company's production assets. That's a composite of how much we have determined the asset value is for each of the different producing areas that an oil company owns and is producing oil from. And then after determining a compilation of those net asset values of their production, we're going to calculate the equity value, which is essentially the enterprise value less the debt. Now, using our financial model, we'll forecast the free cash flow to harvest those energy assets that the company currently owns. And we're able to do this as independent E&P companies generally have very detailed information on the acreage it owns, the wells, geology, decline curves, how close the wells are spaced apart. So we're able to really dial into how much oil we think those companies are going to produce and how quickly they could produce that oil. We're also going to assume the number of oil rigs that they use in order to drill new wells and how quickly they're going to drill those wells, and then the amount of free cash flow that they're going to use to reinvest in that drilling. So we will update our forecast to include new energy assets as they're made. But again, when we're looking at those independent E&P companies, we're really able to drill down to their specific production assets. Now, for other types of energy companies like the majors, when you think about Exxon or BP, or those other companies in some of the other industries such as midstream and downstream, or even the services companies, we're going to use just purely that discounted cash flow model instead. So for example, the major diversified producers, they typically don't provide, or we're not able to get that same level of granularity in their production data as we do for independents. So for example, they might own acreage that hasn't been fully explored, or we don't have the data available. And then it's further complicated by the other business lines that they have, such as expansion into renewable energy sources, which requires a very different method of evaluation.
Okay, thank you. So that third factor is the valuation of a company's cost assumptions in their production plan. So why is that important for investors to consider?
So the cost to develop and produce the oil and gas will certainly impact how viable that production outlook is, and depending on the economic circumstances and the price of oil and natural gas costs. So for example, if the costs are relatively high, then a company's production outlook may only be workable during periods when crude oil prices are also high. And there's really two key categories of production-related costs, that we're really looking at as our key factors here. So first would be capital expenditures, and then second would be operating expenditures. So CapEx, or capital expenditures, that's the cost to develop new resource reserves. So essentially, companies must continue to reinvest in new exploration and drilling in order to maintain their production to stay in business. And ends up being a balancing act as far as just how much of that development they want to do in CapEx, then again, versus how much they want to reward shareholders in different types of distributions. So think of CapEx including what they have to do in order to be able to build new reserves. Those operating expenditures, that's then the actual cost to monetize those reserves that have been built under the capital expenditures. So we model out the unit cost of production for labor, power, supplies, shipping costs, and so forth. So the capital expenditures, you can find that on the company's statement of cash flow. And then those costs, technically are accrued on a company's balance sheet and then expensed as those assets are then used and production is made. The operating expenditures, those are actually expensed directly on the company's income statement as they're occurred.
Thank you. So actually, I thought we could maybe drill down, pun intended, into a company's management and how do you sort of look at their or see that they're spending their capital effectively?
Well, the main indicator there is we're going to analyze whether or not a company's finding and development costs are low compared to the rest of the industry. So this is a measure of how much capital expenditure is spent per barrel of reserves that's added. So those companies with low finding and development costs, that probably indicates that the management is using its capital very efficiently to build its reserves, and of course then they will have more oil to be able to pump out of the ground in the future.
As you've mentioned, capital is something that you look closely at, but it's not just the cost to run the business that your research team considers. The fourth factor you weigh is how the company balances its capital risks and financing costs. So which metrics do you look at there?
So higher debt typically means that you can generate higher returns on the equity when crude oil prices are rising. However, when prices decline, there's always the potential for bankruptcy risk should a company's debt levels get too high and the company's then unable to be profitable enough to be able to repay principal interest as it comes due. So the volatility of crude oil prices means that the financial uncertainty for oil and gas companies is generally going to be higher than many other companies. So I consider really two key metrics when I'm looking at this. So first, we're going to think about and determine what we think the cost of equity is for that company. And that's going to be based on how much shareholders expect to be able to generate based on the risk that they're undertaking. So that cost of equity is determined by using our uncertainty rating. And an uncertainty rating is the degree to which we think we can accurately forecast that company's performance far into the future. So for example, if you think about like a food and beverage company, typically they're going to have lower uncertainty ratings just due to the defensive nature of their businesses. Whereas someone like a technology companies have higher uncertainty ratings because they can have greater swings in their performance over time. Now that uncertainty rating also then factors into our overall star rating for the company. And we use a star rating to denote how much we think a company is overvalued versus how much it might be undervalued. So a 5-star rated stock would be a company that we think is significantly undervalued, whereas a 1-star stock is a company that we think is very overvalued. So the lower the uncertainty, the less a stock price needs to deviate from our intrinsic value to become a buy or a sell rating. Whereas a company with a very large uncertainty, that's a company that we're going to want to see much greater margins of safety from that intrinsic value before we believe that stock could be a buy. And then finally, the cost of debt. So again, that's how much does the company have to pay in interest to be able to fund itself with a debt. So we'll look to the liabilities on the balance sheet, like the amount of bonds and the loans outstanding, and where it would cost them to be able to finance new debt in the marketplace today, and use that for our cost of debt and our weighted average cost of capital.
So as you said, debt is something that's critical to look at. So what levels of debt might an oil and gas company find itself in financial danger?
In our view, the company will be sustainable so long as that cash flow remains high enough to be able to service that debt and the equity at the prevailing crude oil prices. So the one metric we probably are going to watch most closely is going to be net debt to EBITDA. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And that's oftentimes used as a proxy for cash flow. So generally, I'd say we're comfortable with companies with 1 to 2 times debt leverage through an entire business cycle.
Thank you. And the last factor in the valuation process of an oil and gas company is the economic moat. This is somewhat of a term we don't hear too often. So what is an economic moat, and why is it really important in the energy industry?
So essentially, we're just looking at the company's ability to maintain its long-term, durable competitive advantages over the competition over long periods of time so that they're able to maintain their profitability. Now, specifically for oil and gas companies, we're looking to see which companies can produce oil and gas most cheaply. And so therefore, they're going to be the safest when oil prices are low, and then also have much larger profit margins when they're high. So therefore, they would be companies that we would look to say that they have a wide economic moat, within this industry. Now, there's a couple of different factors to consider when determining just how low cost, an oil and gas company can be. So the first thing, where are those companies' reserves on a cost curve as compared to others? And that's going to be based on the geographic location of its resources. So for example, are they easily accessible? Do they have supporting infrastructure? Do they have easy access, to distribution and so forth? And then we're also going to look at the type of geologic formation that those resources are found within. So certain types of geology are easier and cheaper to extract from, whereas other geologies, such as shale formations, are going to be more expensive to extract from, as companies need to frack the shale there in order to be able to extract the oil and the gas. So those type of factors help us to determine, the company's ability to generate what we're looking for as excess returns on invested capital, or ROIC, and that's going to be compared to our mid-cycle oil price of $55, per barrel for West Texas.
So speaking of these economic moats, something that is related to that is maintaining a competitive edge. So how much consideration do you give to the rising emphasis we're seeing among investors with environmental, social, and governance issues when you are valuing oil and gas company?
So for the oil and gas industry, I think the biggest risk to significant changes in the intrinsic valuation for energy companies, in general, would be whether or not globally we could get to net carbon zero in 2050 or even beforehand. So if we were to get to net carbon zero even sooner than that, we could see oil consumption being lower than what our margins are. Now, we also do think that there are a number of mitigating factors to that we've incorporated into our long-term analysis. So, for example, we already do incorporate what we think is an above consensus view for the transition to electric vehicles. And we also note that with oil and gas, and specifically oil products, consumers really can't use substitute products, for those other than for EVs. So, for example, when you think about plastics or jet fuel, both of those do require petroleum-based products. Now, thinking about some of the other risks, on the environmental side, we look specifically to how does a management team manage their own carbon footprint. So what actions do they take to reduce their own carbon emissions, such as reducing flaring, electrifying their own fleets, or taking other actions. And then we also look to see what actions they take in order to mitigate carbon. So again, are they taking on different carbon recapture projects, or planting trees, or doing other things to mitigate that carbon. And then finally, the governmental risks. Probably the biggest risks there that we're watching would just be from greater governmental regulations or limitation on drilling, or the risks of new or additional carbon taxes being put in place. So we wrap that all up into our ESG risk rating assessment, and that's available on each of the different companies that we follow, and that's going to be available on our website and all of our different research products.
Thank you. Yes, it does seem that the ESG approach is really becoming something that investors are more concerned about these days. So yes, so thank you very much for sharing your approach to researching oil and gas stocks and sort of pinning down a fair valuation for the energy sector, David. So now, just before we head over to our live audience Q&A, I just wanted to share with our viewers where they can find some of the Morningstar research reports in WebBroker and what they can expect to find inside. So we're going to go under Research and Stocks. From here, I already have a company listed, and we can see sort of in the center of it, the page, the Morningstar reports. So we're going to click on the Morningstar Analyst Report, make it a little bigger for you guys to see, and we can see that the company in question, we can see their star rating up top, and we see that Morningstar uses a 5-star rating system. They do provide several things on this page already. The last price, the current fair value estimate they give this company, and then a ratio of price to the fair value, above 1 being overvalued and under 1 undervalued. They list several different factors they look at, like the economic moat, the moat trend, the uncertainty, and that relates to a company's ability to earn excess returns in the belief of Morningstar. They talk about the ESG risk rating, which we've discussed in our conversation with David, and that is out of 5 globes, with 5 globes being low risk and 1 globe being high risk. And here they also show a chart that shows you the price to the fair value and if it's been over or undervalued in the last few years, and the corresponding Morningstar rating. The whole report has a lot of information from the analysts. A lot of the report is just the analyst discussing the company and various factors related to their valuation. So on the third page, they basically look at other companies in the same industry and give comparisons regarding sort of the closing price versus the fair value. So that is shown within the third page of the report, just to give you a comparison of other companies that you might want to look into. The next section of the report, there is a lot of analyst details written down, so we'll skip that. We'll go to the comparison. So there's a competitor comparison versus some of these other companies and what their history has been like with their over to under valuation and their Morningstar rating over time. The 14th page of the report here, it gives us basically the company's historical summary of their financial statements. So if you want to go over the last decade of their financial statements and how things have changed over time, that's something you can do in here. And if you want to go into a bit of the methodology, they look at basically the last couple pages really do describe a lot of where the analysts, where they, how they value the actual companies and how they give you that star rating. So that's found sort of in the last 2-3 pages of the report. That really does cover the report. Okay, hopefully that demonstration has our audience members eager to start digging into all the fantastic research material we have on hand. So now let's head over to our live Q&A and hear what our viewers want to learn more about.